You're coming at this from a totally different perspective. Why does energy jump out to you here?
It does. It speaks to the rotational aspect of this bull market as it stands. You know, a lot's been made about this unwind in the technology sector. It's paused after a terrific run. I think that trade is still intact. It comes back. But right now, the key trade has been the breakout in the energy sector. It's just finding what have been the laggards of the move to the upside, energy rather range-bound for much of 2023. Now just starting to break higher to the upside, both in absolute and relative terms, and I think there's some runway there.
Exxon, Chevron, those don't look like they're your top ideas. What's going on with those stocks?
Well, I mean, those are your low volatility, high dividend paying safety stocks. I think what's notable through this correction is that there's been a preference for more cyclical areas. I mean, they've risen. They're just to a lesser degree. They're actually underperforming versus XLE. So I think it's really more on the E&P side. Since it's not a bearish call on Exxon or Chevron, but just trying to find a little bit more juice and some of these long-term E&P stocks that are breaking up through big long-term levels.
And I'll come back to that in just a second. But conceptually, it's interesting to me that we're bullish on the energy and production stocks, while at the same time hearing that Permian production has likely peaked. I don't know if you have a comment. Look, I know you're just looking at the charts, but I don't know if we need to reinterpret what that means, or if the idea is even if production has peaked, higher prices would be supportive, oil price would be higher, supportive of higher stock prices.
Yeah, it's just not, I don't think, a big structural secular call on the overall oil, I think, which has really found a floor, and these stocks are finding a bid. And, you know, after the underperformance the sector has faced from 2014 to 2020, it was a big two-year run there. I'm still unsure if this is that structural shift in the sector. Instead, I see a lot of similarities to big moves in sectors like technology after the 2000 bubble, financials
really?
After the great in 08 as well. You have a big run, and then you're range bound for a number of years. That's fine, and I think you're finding the lower end of that range, and some of those stocks can work in that backdrop.
So you're kind of calling for a mini breakout within a range, that sort of thing, or do you think this could really be a big one?
I think this is a tradable call. I think it works through the Q3 season, as we've seen here. And I think there's some individual components that could work for the long term as well here. If we're thinking about a structural shift, let's find the stocks that are driving that structural shift.
And I know some of the names that you like because they've cleared their 2014 and 2018 peaks, which not everybody has. Conoco, Hess, Marathon, is that the ones you're referring to?
Those are the ones through some combination of falling less on the downside or acting as leadership on the way back up. That's where we're seeing meaningful strength for the long term. They've reset with the sector year to date, and now as they're turning higher, moving above their 200-day average, the setup is there for those long-term, multi-year breakouts are just starting to get going again.
Did you kind of run this for the XLE more broadly, or are you more interested in finding the ones that have the most beta, so to speak, instead of just buying the broad index?
It's looking at the XLE. You could see a sub-industry theme. It's a lot more on the E&P side. Some of the service names, they're more the beta trades that could work for a short times, but if they pull back, you run that risk where you still have a long-term trend of lower highs that could start getting going again.
All right, I'm just going to throw it to you because, you're here. I can't waste the opportunity. Overall market, range-bound through that's what Barry Bannister has been saying, some others as well. What do you think?
It hasn't run its course, this seasonal correction. We've argued that the long-term positives outweigh the near-term negatives. I think this is a seasonal correction that proves temporary and an opportunity to buy a bull cycle that we think is only in its middle innings. With that said, these corrections develop in three waves. I think we're in the first leg lower. Look for a counter-trend bounce, but maybe some additional basing in the September months ahead of another strong Q4.
Plenty of time to study, the energy stocks, if you will. Get that ready. All right, Ari.